Good morning and welcome to your Financial Empower Hour. This is Jason Cryderman with Great Lakes Investment Advisors, and I'm here once again with my awesome co-host, Mr. Tony Shore. Tony, how are you this morning, buddy?
Oh, I am alive and awake, which is great.
There's two good things for all my viewers and listeners out there this morning. Tony's not lying. Being alive and being awake, two great things for an awesome Sunday morning.
Couple of positives just to start our morning. I'm alive and awake. I've drank about 40 cups of coffee in anticipation of trying to keep up with you. Well, I'm trying to keep up with you on the show, and just your energy level that you bring is unbelievable. Listeners and viewers out there, you have no idea what it's like to try to keep up with Jason Cryderman. I mean, this guy is, we call him Super Jason. That's what we call him.
Well, thank you, Tony. But, well, you know, I'm a lot of people say, boy, you're very passionate. And I truly, from everything I do, right, from my family to my kids to extracurricular activities to being a financial advisor and helping families plan their retirement and live an awesome, successful, happy retirement. I am very passionate. I love what I do. This truly is a passion of mine. No matter what I'm doing, again, I just try to get up every day and look at the guy in the mirror that's looking back at me and tell him we're going to have an awesome day, right? We're going to do awesome things today. And today's going to be better than yesterday. And just can't imagine what tomorrow might bring. And so, in doing so, it brings a lot of passion, brings a lot of excitement. I've never once been called a bump on a log. No one's ever said, "Hey, you sit around, don't do much, do you, Cryderman?" And I said, "Oh no, you won't say that about me." But so, Tony, how's everything been going over there in the great state of Minnesota?
Well, it's been raining, which is good. Our farmers need it. And so it's good to get some rain. I mean, it doesn't make working outside easy, but I'll tell you what, my lawn, you're going to need to come over and mow it again, Jason, for me, because
I'll send Carson over. You can give Carson that $20. It wasn't
yeah. Okay. We'll give him a little more than 20. We'll take care of him. I probably still owe him from some bets I have lost.
Well, I don't know.
Lions.
I think you guys might be even up right now on the bets. I think you might have took him the first game or two, and then he got back in the game. But so wait a minute. So you said it's raining over there, which has been needed, the farmers. So Tony, that's totally different from us. So as of right now, it hasn't rained in a couple days, but for the last month or more, we have had probably 3/4 of the state of Michigan under flood warnings, flood watches.
Wow. Okay.
We've lost roads blown out. We've had bridges blown out. I mean, it's all over Michigan. Now you drive down the road and you look out in the farm fields, and what used to be a cornfield or a bean field or a beet field, it looks like a pond.
That's not good.
3/4 of the farmer's field is underwater, and that's not good because we're going to be way behind. Obviously, the farmers that
because it's been planting season, and if they planted before the floods, it might not come back. It might kill it, and if they didn't plant, then they're going to have to wait that much longer to plant.
It's a double-edged sword for them. You're right. So the ones that got it in early, they got to hope and pray that it just didn't get flooded out too bad. And the ones that have not got seed in the ground yet, well, I think they're going to be quite a bit behind this year just because of. But the reason I say that is because we always joke on the show all the time about how whatever weather Tony gets over in Minnesota, about a day or two later, we get here in Michigan. Yeah. And if they've been pretty dry this spring and they're welcoming these rains they're getting, well, that weather pattern didn't flow as usually as it usually does. And,
no. I mean, we've gotten the northern half of the state's probably gotten a little more than they need, but all our farms, which are in the southern half of Minnesota and down south, they needed a little more rain. So, but it's going to rain solid for the next couple of days. So they'll probably have enough.
Yeah, well, good. I hope you do get enough, and then when that rain is done over there, let's not do what you usually do and send it my way.
Oh, we won't.
We don't need any more of that right now.
We won't send it your way. Hopefully this time. Well, hey, but speaking of Minnesota, it's been all sports here. We've got two teams that are looking pretty good in the playoffs. The Timberwolves are in the NBA.
That's right.
Playoffs and have been looking good. They've been winning games, and so have the Wild. The Minnesota Wild hockey team is actually in the Stanley Cup playoffs. and they've been looking pretty good. So excited about those two teams. Plus, it was the NFL draft. Did you watch any of the draft?
So I didn't get to watch much of the draft. Pretty busy with business. We had a couple of client events last week. Actually, on Thursday night when the draft started, and then over the weekend, Carson, Josie had track meets and a band event. Carson had a baseball tournament. So we've been really busy. But I did catch quite a few of the highlights of Timberwolves games, of the obviously the Wild, the hockey team. It's not often, Tony. I'm going to give you this stage time because it's not often that Tony Shore brags about the Minnesota sports results. So so for those of you that are viewers,
it's a rarity. Sure,
you probably are thinking, "Wow, that's not normal."
It's
Tony Tony even really like kicks his own team when they're down, right? Because he's like, we're just not good. But no, it's awesome. I think it's really cool that Minnesota's got the NBA, the NHL, both of them in the playoffs, both of them doing pretty good.
Yeah.
How did you guys fare? Did you guys fare good in the draft? Is that why you brought that up?
No. In fact, I was trying to just sweep it by. I was trying to focus on the hockey and the basketball. We did I think we had a horrible draft. And boy, Vikings fans aren't happy with the Viking front office, or whoever's been the new GM, whoever made those decisions. I mean, they could turn out, the draft is kind of a, I don't want to say crapshoot, but it's kind of a, I mean, you never know with the draft. I mean, undrafted free agents end up being the star players, and number one drafts end up being busts and never working out. You never know. Nope. But so maybe they know something we don't, which I hope they do. I would hope they know more than I do about these players.
We would hope so, right?
I get the positions, but I don't get the players. Like they picked a guy for the line that has a bad foot. Okay. I'm just like, and he's huge. He's like 6'8" and 365 pounds or so. I mean, this guy is a monster.
He's a monster and he's injured. So we might as well.
Yeah. I don't know. That was one of their first picks. So I don't know. We'll see. We'll see. I don't know. I honestly think you and I are going to have to worry about Chicago more than anybody this year.
Well, I would also say, last year we talked about that, how Chicago just, came out of nowhere, and like they're building something over there they haven't had since the Ditka years, right? And,
since 1985.
Yeah, it's been crazy.
Since they won the Super Bowl, they haven't had a decent team.
When they had McMahon and Refrigerator Perry and Walter Payton, and I mean, it was just what a team, right? And so, I mean, watch how they played last year. And then
I think they're making improvements. So we'll see. It's going to be an interesting division. Right now, I mean, Green Bay, Detroit, Minnesota, Chicago. It's anybody's division when it comes to football. But your son had his first baseball game of the season. Is that right?
He did. Yeah, he did.
How'd that go, Carson?
Yep, Carson. So, this wasn't the first scheduled tournament, as I mentioned to you, with all the rain over here. So we had a tournament scheduled 2 weeks ago, but due to all the rain, unfortunately, it got rained out, and so we didn't get to play that tournament. So this past weekend, we did have a tournament down in St. Charles, which is about 45 minutes from our house up in Sanford. And so we have a game scheduled Friday night, and all day Friday, it's been threatening rain. And all of a sudden it's like, okay, it's letting up. The radar looks like it's going to break up. Everything looks great for a wonderful evening of baseball. Our head coach is calling the tournament director down there. Hey, how's it looking? He's like, it's looking great. The fields are in great shape. It's not looking like any rain. So all the families drive down from the Midland Sanford area. We get down to St. Charles. We do our full warm-ups. We're probably thinking the game ahead of us is going to be done in about 15 minutes. We're all fully warm. We're loosened up. We're ready to go. And the skies opened up, and the rain came down in buckets and buckets upon buckets. And they delayed that game ahead of us that was playing. They delayed that for about 45 minutes. And 30 minutes in, it was clearing up. It looked great. Looked like, yep, we're going to get a chance to play. We're going to be a little late, but hey, that's okay. It's a beautiful night to play baseball. And lo and behold, at about the 43-minute mark, if those guys didn't open up again, Tony, and before you know it, there was as much water on the fields as the bases were high. And the outfield, and it was a really crowned infield, but it was all running to the outfield. Oh, it was just crazy. So anyhow, they canceled our game Friday night.
Oh, so tell those kids to get out there and play anyway. Play in that water. A little lightning never hurt anyone.
So needless to say, the lightning's what you got to watch out for, right? That's something we don't want to joke around with.
No,
hey,
no, I'm kidding.
Rain, not a big deal.
Yeah, they could play it. It'd be fun to watch them play in that water. They'd probably have fun with it.
It'd probably turn into a heck of a lot different game than baseball. I promise you. And I'm sure the kids would have a heck of a lot more fun, right? So anyhow, they canceled that. They actually postponed that game till the next day. So then we all hopped in our cars, drenched, soaking wet, drive 45 minutes back home, and started all over again in the morning. So the morning we had a game. Carson's team ended up winning. Had a really nice game, won that game. We had about a 5.5 hour delay between games, which is not fun. It's not fun to sit around a ballpark and we were just a little bit too far away to drive, 45 minutes to an hour home, sit there for an hour or two and turn around and drive back. So we grilled out. Some of the parents brought a different, tables and chairs and grills and food. And it was a great afternoon, but just a long time to sit at the ballpark between games. And it was very windy and very cold. So needless to say, Saturday night's game did not go as well as the first game.
Sure.
It was a pretty brutal result to that game. Our boys, not one of them showed up to play baseball. It was very not good. Let's just leave it at that. And then so we go home, wake up Sunday morning, have a game early. We won that game Sunday morning. So now we're 2-1. We're going into the semifinal game, which was yesterday afternoon. And what a change of weather. It was 70 degrees, not a cloud in the sky, not a blowing of wind. It was just a beautiful, beautiful day at the ballpark. For my viewers, you can probably see I'm a little red. I got wind burnt and chilled on Saturday and sunburnt on Sunday. So I got a combination of skin colors going on.
But they ended up doing well, right?
They did well. We ended up losing in the semifinal game, but only by 2 runs. And one more inning, and I would have been a totally different ball game. But
sure.
Great weekend. So first term of the year, kids ended up 2-2. Carson did awesome. His teammates did awesome. They had a lot of fun, really, and that's what it's all about, right? So,
yeah, that's what it's all.
On to another tournament next weekend.
There you go. Wow. Well, you're a busy dad, and I know you're busy with, I know you've been meeting with clients, and you had an event with your clients last week, and you love hearing from our listeners and viewers. So before we jump into today's topic, we are talking about whether you should pay taxes now or later on those retirement funds that you've been saving. What do we do with those? It's a great topic. You've got some great answers for our listeners out there, some great advice. But first, let's give away 10 copies of your book. And that is Empower Your Retirement, right?
That is, yeah.
There you go. And plan for you hope for the best, but you plan for the worst, right?
Well, there's hopes and planning, but really, ultimately
plan for the best and prepare for the worst.
Best, but prepare for
the worst. Yes. No hope involved.
Well,
you have to have a plan.
And dreams. There's a lot of hopes and dreams in retirement, but if you don't plan properly, how do your hopes and dreams come true?
Yeah, but how do we get a copy of that book? You're going to give away 10 copies right now to the next 10 people who contact the office, reach out to the office and say, hey, I want a copy of that book. If you get the messaging service or voicemail, just leave a message with your name and your information. We'll call you back and get your information, send you out a copy of the book. No charge, no obligation, no postage even. All you have to do is call 989-835-7203. That's 989-835-7203. All right. And we'll be right back with more of your Financial Empower Hour. All right. You're listening to your Financial Empower Hour. I'm your co-host, Tony Shore, and I'm here with our host, the man with the plan, is Jason Cryderman. Now, Jason, this topic today, I find it interesting because what do you mean when you say tax now or tax later? 401ks, IRAs, that's a big question. Do you want to pay taxes now or later? Nobody wants to pay any taxes ever, right?
Well, the final answer, right? Final answer is I don't ever want to pay taxes, right? But the reality is when we have income, that's going to be taxed. When we have investments that grow, those are going to be taxed as well. The return, the earnings, or the growth on those investments. And so, it becomes a big question of when people think about tax now or tax later, most people are thinking about their income that they're going to invest inside of either a 401k or another type of corporate sponsored company plan, an IRA, which is an individual retirement account, or maybe a Roth IRA, which is also individual, but it's a Roth, which is tax-free. So the differences in those accounts, Tony, is first of all, taxes are confusing. I think they were written that way on purpose. I think most of the tax laws and tax codes were written to be confusing, to be scary, to be overwhelming. And so people would get paralysis analysis and they would simply do nothing because they just didn't understand it. They were afraid to get in trouble. So that there again in lies where working with a professional, whether it be a fiduciary advisor like myself, another member of my team, a CPA, a CFA, working with somebody who truly knows and understands tax rules and tax laws can truly help you make the best decisions for, number one, your income, number two, your investments, management of your investments, and eventually pulling money out of those investments into and through retirement in the most tax efficient manner. So the big difference, Tony, is when we put money into a 401k or into an IRA, that money is tax deferred. Now, what that means is we can earn income in a given year, but if we deposit that money into a 401k or an IRA, we don't pay any income taxes on that amount that we deposit as our contribution. So it's essentially tax-free income that year. And that's what's important to remember is it's not tax-free forever. Just that year, you didn't have to pay taxes on it, income taxes. And then all of the growth inside of a 401k, another corporate sponsored plan like a 403b, 457, or an individual IRA, all of the growth year over year grows tax deferred. Now, deferred does not mean tax-free. Tony, a good word for deferred or a good term for tax deferred is kick the can down the road. I will pay the bill later. People have to understand that all the money that you put in, all the growth inside that 401k, that IRA, that money is going to be taxed eventually. Either when you take it out as income in retirement, your spouse takes it out as income, or your beneficiaries, anybody that you name as a beneficiary under you. But we will touch on before the end of the show today. I'll make sure I bring it up now so you don't let me forget, Tony, is the only way we can get money out of our retirement accounts tax-free, 100% guaranteed tax-free under today's current law is something called a qualified charitable distribution. It's called a QCD. So, Tony, please don't let me forget to talk about that before the end of the show. Maybe it'll be the last 2-3 minutes before we go because I think it's very, very important topic. But, yeah, so, let's chat more about this pay taxes now, pay taxes later topic. I can't hear you.
You're right, and this decision can impact your retirement by tens of or hundreds of thousands of dollars.
Absolutely,
because you're talking about, okay, I'm going to forego paying taxes on this smaller amount that I've earned this year by putting it into my 401k, 403b, traditional IRA, but then it's going to keep growing, compounding interest over the years, and in 20 years, when I am taking it out and I'm 70 in retirement and I take that money out. Then I'm going to pay full taxes on everything I take out of that account. Everything in it's taxable. The growth, the principal, every penny's taxable. So that's why I know you've said, would you rather pay taxes on the seed or the harvest? Well, the seed, because it's a smaller amount.
Absolutely.
But there are other factors. People think, well, I'm going to be in a lower tax bracket, so I'd rather pay taxes. I'd rather defer taxes now in my peak earning years and then not, pay taxes when I'm in a lower tax bracket, but you're paying it on a higher amount. And a lot of people think they'll be in a lower tax bracket in retirement, but that's not necessarily the case, is it?
No, that's not necessarily the case. And it's so true. I've met a lot of families and investors over the last 24 years of being a fiduciary advisor. And a lot of them do think, well, I've heard that I'll be in a lower tax bracket, or I think I'll be in a lower tax bracket when I'm in retirement. Well, just because you hear something or you think something doesn't always make it true, right?
Right.
Because who is in control of tax brackets? And it's not us. It's not us
Nope.
when we're retired. We don't get to pick which tax bracket we're in.
Nope.
We hopefully have comfortable income to live a happy and successful retirement, whether that be maybe some pension income. If you're still lucky enough and fortunate enough to have one of those pensions, that's going to be some Social Security income. And then maybe it's going to be some, I don't know, rental income or farm income, or it's going to be income from your investments, from your portfolio. Well, any of that income, it most likely is going to be taxed in some form, either taxed every year when you earn it, or a majority of retirees today get a good portion, 30 to 50% of their retirement income out of their 401ks or their IRAs. And yes, that money has never been taxed. Most of that money, unless it was in a pre-tax or a Roth portion, none of that money has been taxed. So when you take it out in retirement, it's going to be taxed. And so, I tell people, if you want to live, I'm going to make these numbers up. Okay. So, but if you want to live $100,000 lifestyle, you're going to get $100,000 of income, no matter where that's from, whether it's from your employer or Social Security. Most of your employers and Social Security aren't going to give you that much in your pension and Social Security. So you're going to pull a good majority of that, maybe 30 to 80% of that $100,000. You're going to pull from your savings and your investments, mostly from probably your 401k, your IRA. So you are still going to have a nice income level, and the IRS gets to control which tax brackets you're in. And I don't know if anybody has paid attention at all to tax brackets over the last, let's say 10 to 15 years, but taxes have been income taxes, federal income taxes, under the Tax Cuts and Jobs Act of 2017. 5 of our 7 federal tax brackets were lowered, reduced, cut. And eventually, people may not know this either, but taxes, the revenue the government generates from taxes, is the only source of revenue of the government. They tax. That's how they get their income.
Yep.
And with their income, in ways being reduced, cut, lowered, when the Tax Cuts and Jobs Act of 2017 cut 5 of our 7 federal tax brackets, eventually those tax brackets are probably going to go up. And let's say they go up in 5, 10, 15 years. If you're in retirement in 5, 10, 15 years, you need to plan for the best, prepare for the worst.
Yep.
You need to plan that taxes will never go up, right? That's your plan. But I'm telling you what, prepare. Be prepared that taxes are going to go up.
Yeah, 39 trillion is the national debt. Taxes have to go up at some point. Like you say, right now, we're at historic low tax rates. Tax rates are at a historic low. So why not take advantage? And I think there's a lot of reasons. Now, we're talking about, I know you talk about buckets a lot, and I know you work hard to have your clients get a tax-free bucket of income for retirement. And so people are saying, okay, so maybe it is smarter to pay taxes on this money now and let it grow tax-free. How do I do that? And before we do that, we're going to take another quick break, but we're going to come back and tell you exactly how you can do that, or one of the possible ways. There are a few different strategies that are involved. And Jason, I know this is something that you've helped so many people with. Speaking of that, you talk about this in your book as well. And I would highly recommend that our listeners read your book. And that's called Empower Your Retirement, Plan for the Best, but Prepare for the Worst. We're going to give away another 10 copies. All they have to do is call the office. Your team there will get their information and ship them out a book, or they can set up a no charge, no obligation consultation to ask you directly any questions, you and the team there at Great Lakes Investment Advisors. So pick up the phone, call Jason and the team at 989-835-7203. That's 989-835-7203. And you can also go to the website, greatlakesinvestmentadvisors.com. And we're back with your Financial Empower Hour. I am your co-host, Tony Shore. Jason Cryderman is our host. And Jason, you've been talking a lot today about tax now or tax later. Tis the question, and what's the answer? And I bet it varies for some people. For some people, it probably makes more sense to get the tax break now. But for a lot of people, it doesn't, or maybe it's a combination of those.
Yeah, you're absolutely right, Tony. So, there's one answer that I have probably said over 1,000,000 times in my 24 years of being a fiduciary advisor, whether it's in one of the educational classes that I put on a monthly, bi-monthly basis, it's, on the radio show, it's the answer that people are like, well, what the heck does that mean? and the answer is, people say, gee, should I be putting money in my 401k? Should I be putting money in my IRA? Should I be putting money in my Roth? Which one should I put the most money in? And that answer, Tony, is it depends. It depends. And that's probably the most common answer I have to initially tell almost everybody that asks me questions about anything to do with their financial planning, investment planning, tax planning, whatever it might be, is it depends, because everybody is in a different, unique situation, depending on what your debt is, depending on what your income is, depending on what your risk tolerance is, depending on what your health status is, depending on your family dynamic. There's so many variables, what age are, just so many variables, Tony, that come into play that truly it depends probably comes out of my mouth 100 times a day when talking to people. But again, my job as a fiduciary advisor is not to let them go with that answer. That's not my final answer. My first answer is it depends. And I always follow it up with, it depends. So let's find out. Let's figure it out for you, Tony. What's in your best interest? Let's find it out. Let's roll our sleeves up, do some due diligence, do some work, and find out, should you be putting more money into your 401k on a pre-tax basis, or would it maybe be more in your best interest to open up a Roth IRA, contribute some or maximize the contribution amount into the Roth IRA per year. And then once you are retired, we call it tax diversification. You want investment diversification diversified. And you mentioned the tax buckets, Tony, and I call it diversifying your tax strategies, right? Diversify your tax strategies of income, and especially, your investments before retirement, but more importantly, that income you're going to receive in retirement. For example, again, I mentioned earlier, if you had $100,000 of income, let's say 50% of that was taxed as ordinary income, but let's say you had tax-free investments out there that you could pull the additional $50,000 100% tax-free. Well, you just kept yourself potentially in a lower tax bracket with the exact same amount of income as somebody in the higher tax bracket, which means you're getting more money and less goes to the government in the form of taxes. Where would you rather find yourself? Paying the same or higher taxes to the government, or getting the same income and paying less taxes to the government?
Well, obviously paying less taxes. We all want to minimize that tax burden.
Absolutely.
Yeah. Yeah, that's where it's at. I think that's huge. So, I imagine that time horizons play a part in this, right? I mean, obviously, it depends on when you need the money, when you pay do I pay it now or pay it later? Well, what is the money for? How soon are you going to need some of it? That type of thing. And I guess we have to get to the main source and talk about Roths. I mean, this is where basically what we're talking about is the difference between keeping it in a traditional 401k or 403b, 457, or a traditional IRA versus doing a Roth conversion into a Roth 401k or a Roth IRA, correct?
Yeah, that's right. So good point to make. Again, a 401k and a traditional IRA, those are tax deferred. So you put the money in, it's not taxed when you put it in. All the money grows tax deferred. You will pay ordinary income tax on that money when you pull it out. But with the word Tony just said, that Roth IRA, the money you put inside a Roth IRA or a Roth 401k, if you're fortunate enough to have a Roth portion or a Roth option inside your employer 401k, any money you put into a Roth, you will pay income taxes on that year. It has already been taxed. And all of the growth inside of the Roth is tax-free. When you take the money out of the Roth, this is for you, your spouse, your kids, your grandkids, all beneficiaries, anybody and everybody that takes money out of a Roth IRA. Under current law, it is 100% income tax-free. Remember, the money you put into that Roth was already taxed, the money you put in, but all the growth is tax-free and all the income under current law is tax-free. So you're absolutely right, Tony. A lot of people say, I want tax-free. Well, again, the answer is it depends. Should you put all your money into? Well, it depends on all those variables you mentioned: age, risk tolerance, time horizon, 10 years before retirement, 5 years into retirement. Do you need the money within the next 6 to 12 to 18 months? All those variables come into play to determine should you, and if you should, how much or at what level should you be contributing to the 401k, to your IRA, to a Roth. You mentioned converting. Maybe people start converting money from their IRAs and 401ks over to Roth IRAs. Definitely a strategy I truly believe in, right down to my core. I think converting from IRAs to Roths is a huge benefit for most investors, for most families, not for everybody. That's why, again, it pays to work with a trusted fiduciary advisor who knows and understands these rules and these laws and can help you determine, hey, where are you? What are your opportunities? And then how do you take advantage of them?
Yeah. Well, and Roth conversions are great, but there are rules, there are income limits, there are contribution limits, and there's a 5-year rule, right? Where you must have
multiple 5-year rules. Yeah, absolutely.
Yeah. So you have to have a Roth for at least 5 years before you start drawing money out of it. At least your initial Roth. Once you start a Roth, then and you fulfill that 5-year, you're fine. But so time horizon matters, right? I mean, Absolutely. If you're 75 and need the money right away, a Roth conversion probably doesn't make sense, but you have to look at your situation, right?
Yeah,
Everybody's
absolutely.
Individual time horizon.
Yep, they are. And like Tony just said, so let's say you're 75 and you need the income in a very short term. Maybe it's monthly right now, or it's within the next short term, 1 to 3 years or less than 5 years. And so maybe a Roth conversion doesn't make sense for you. Or maybe it does if you have other sources of income you can pull off of for that 5 years until you can access your Roth IRA later in life at tax-free point at that. So again, the answer is it depends. It really depends on a whole lot of variables of what situation you're in and how can I help you maximize that tax deferred strategy to maximize your income, but minimize the negative impact of taxes either on your investments and or long-term income into and through an awesome and successful retirement.
Yeah, that's huge. Well, hey, right now, I want to let our listeners know, don't go it alone. Don't try to do a Roth conversion or figure this out on your own. And your tax preparer probably isn't looking ahead and doesn't have the experience with retirement planning. You should work with a CPA on your current taxes. And I know, Jason, you work alongside tax professionals and for your clients, but you have to do future tax planning. It's part of retirement income planning, and that's what you do, Jason. So for our listeners out there, if you have questions about this topic and you want to get a second opinion on where you're at, or maybe a first opinion, and maybe you don't have a written financial plan, maybe you don't have a tax plan set up for in retirement, you need one. So, Jason, I want to let our listeners know you're offering a no charge, no obligation consultation. All they have to do is pick up the phone, give you a call, and set up a time to come in to get that consultation. And again, there's no obligation to that. You'll meet with them, talk to them. If they want to continue working with you, great. If not, no problem. But at least figure out where you're at. All you have to do is call Jason and his team at Great Lakes. The number is 989-835-7203. Again, that's 989-835-7203. Give Jason a call. Find out what's going on with his kid's baseball career, Carson. He's probably going to be the next pitcher for the Tigers. We don't know. But Jason loves to meet with folks, talk with you, help you out with your finances. Again, pick up the phone. Give Jason a call at 989-835-7203. We'll be right back. And we're back with your Financial Empower Hour. I'm your co-host, Tony Shore. I'm here with Jason Cryderman, our host, the man with the plan over at Great Lakes Investment Advisors. And Jason, talking about tax now or tax later, the importance of looking at the possibility of Roth conversions, because with a traditional IRA, we haven't mentioned RMDs, but when you hit 73, you're going to have to, the government makes you start taking money out of those traditional accounts like 401ks and traditional IRAs. But that's not the case and you have to pay full taxes on it too, and take the RMDs, and that could put you in a higher tax bracket, right?
Absolutely. Yep. So that's important part of 401ks, IRAs, those types of retirement plans that people have to be aware of and be forecasting into the future, right? Plan ahead, be prepared, is what happens with those types of accounts later in life. So there's something called an RMD, a required minimum distribution. That means required by the IRS, by the government. It's required. You must take money out of those accounts, and it's a minimum. They tell you exactly when and exactly how much you must take out. And if you don't, they can penalize you. And it's a pretty hefty penalty on top of taxes. So right now, the current law, you're absolutely right, Tony. The current age for an RMD is 73 years old. Used to be 70 and a half. Then they bumped it back to 72. Now it's 73. And they're talking about even pushing that back further. There's a law that's already been passed that in 2033 or 2035, they're going to push that age up again. But right now, if you or when you turn 73, you need to be planning ahead and preparing to take a required minimum distribution, which is a mathematical calculation. It's not a guess. We can tell you exactly how much it's going to be. You need to plan on taking that every single year out of your 401ks and IRAs. That money is going to be taxed. Can't hear you, Tony.
Yeah, you'll have to pay the full tax rate on that. I was just
absolutely. Yep, that money's never been taxed. Remember,
Yeah.
That's why I started off today talking about all the money that goes into 401ks and IRAs. You didn't pay a penny of taxes on that. All that growth has been deferred. The term for deferred is what? Kick the can down the road. I got to pay the bill at some point in time. I'm just not willing to pay it now. So once you start taking income, and maybe it's when you're forced to take income from the government in that required minimum distribution, that's when the bill becomes due. That's when taxes are owed. All those contributions, all that growth, well, it's time to pay the fiddler, and taxes do become due on the income you're forced to take. It could, you're absolutely right, Tony, it could throw you into a higher tax bracket. It could potentially throw you into a higher tax bracket than you were in while you were working. It could also make your Social Security become taxable if it was not before, or taxed at a higher level, more of it being taxable. It could also throw you into a unfortunate Medicare premium situation. So there's a lot of things we got to think about when we talk about taking, what's going to happen with money coming out of our retirement. So there's where individually each investor and each family should sit down and look at, should I just keep max contributing to 401ks and IRAs, let it grow till I'm in retirement, and then just pull out any of the income I need and just, it is what it is? Or can you do proactive tax planning where, you start strategizing? Maybe you don't do 100% contribution to a 401k every year. Maybe you do 75% of the money you were going to contribute goes to the 401k. Get the company match, and it's still a good plan. But now you start another bucket, and that's that Roth IRA. And maybe you take 25% or some of your income or your investable money, you put inside a Roth IRA. Now that grows tax-free. And then later in towards retirement, in retirement, maybe you start converting out of IRAs into Roth IRAs. Important to point out, Tony, I can't let my listeners forget this, though, is anything you convert from IRA to Roth is taxed as income that year. If you convert money from an IRA to a Roth, it is taxed as ordinary income that year. Could throw you into a higher tax bracket, could increase tax on Social Security, could increase could mess with your IRMA threshold and increase your Medicare premium. So these are all things you need to be aware of. And again, that's why, Tony, you and I can't stress enough how important it is to work with a trusted advisor, a trusted fiduciary like myself or another member of my team that knows and understands these rules and laws. This isn't our first rodeo. I've been doing this for over 24 years now, and I've helped literally thousands of families and investors assess where they are, help make sure they're on the right road, give them a plan, give them ideas and strategies, how they can improve their not only current, but their future financial position. And so, these aren't things you want to wing it and go alone at.
No, they aren't. And before we go, you mentioned charitable contributions is one way to get money out of a traditional IRA or traditional tax deferred account without paying taxes on that money. Explain that.
Thank you. Thank you for not letting me forget that, because I think this is one of the most unknown and unutilized opportunities in the Internal Revenue Code book in our tax laws. Once you reach age 70 and a half, and that's the key. You can't do this before 70 and a half, because that was the old RMD age, Tony. Well, they've been pushing the RMD age back, but they didn't push the QCD, qualified charitable distribution age back. So if you are 70 and a half already, or plan ahead when you turn 70 and a half, if you have money in 401ks and IRAs, those tax deferred accounts, and if you are charitable, if you gift at all to any legal nonprofit 501c3, any church, charity, cancer services, epilepsy foundation, anything that's a legal 501c3 nonprofit.
Yep.
You can have the money come directly out of your IRA, go directly to the church, the charity, whatever it might be, zero taxes.
And it'll fulfill, and you can use it to fulfill your RMD and not have to pay taxes.
Absolutely.
And a lot of people we know in the community tithe to their churches, and that would count. And so rather than write that check on money you've had to pay taxes on,
well, that's exactly it. So let's say
send it directly from your IRA, your tax deferred account, and then you don't have to pay taxes.
It's a no-brainer. So I mean, think about it. It's a no-brainer. So when the plate comes around on Sunday at church and you put in $20, it costs you $24 probably, right? It costs you $24 to give away that 20. Why? Because you paid income taxes on the money.
Yeah.
What if you could give the church $24? It doesn't cost you a penny.
Yeah.
Who wouldn't do that? Who wouldn't give them more?
Yeah.
It didn't cost me anything to give them more.
Exactly.
How much better would I feel? How much better would that help them?
Yeah.
And then the kicker is, not only will it give the church more, not only won't it cost you a penny, the IRS doesn't get a dime of your money.
There you go.
IRS, you
That's
legally
huge.
can avoid giving your money to the IRS if you utilize a qualified charitable distribution under current law. QCDs. Absolutely.
Yep. And this is one more strategy you use along with Roths, along with there's cash value life insurance. There's a lot of ways for tax-free income in retirement and to minimize tax burdens in retirement. And this is what you've been helping people with as part of their overall retirement income plans. So before we go, we're out of time, but before we go, we're going to give our listeners that number one more time, and they can set up a consultation with you and your team and get a book. Just call 989-835-7203. That's 989-835-7203, or go to GreatLakesInvestmentAdvisors.com to set up a meeting with Jason and his team. Jason, great show today. Listeners and viewers, thanks for tuning in. That does it for today's episode of your Financial Empower Hour.